Good afternoon, traders. Welcome to Stock Market Movers, where we give you all the information to keep you guys in the informational edge. Today, we got another great show for you. We'll have one great expert on and a replay today. Seeing as we did get a call out, I ain't going to give the name away. If you caught it in the description earlier in the show, you would have seen a really big name there at 145, but it's okay. We're going to get them back on. We're going to talk about a lot today. We got to get into the bank earnings. We're going to talk about the Fed talk, of course, Bullard and Daly kind of leading the way there. We'll talk about retail sales report. We'll touch Pinterest. We'll touch Google, Starbucks, Amazon drones. Have you guys ever seen one of those? I'll go ahead and I'll show you a picture of that, and we'll talk about why it's important. Let's dive into today's show. Welcome to it, Stock Market Movers, with none other than your host, Money Mitch. Let's get into it.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now, we all know the bull market is here to stay. Money Mitch.
All right, traders, how we doing on out there? Definitely say hello in the chat, especially if you're new to this show. If you don't know already, we give you all the headlines out there on the day, and then we get into some expert opinions. Let's first start diving into the Fed talk today. This is going to be kind of like an everyday segment, at least until the Fed's kind of calm down and stop talking out there. But let's talk about Fed Bullard here. And what did he say today? This started off the market. Bullard saying he's an advocate of front loading the rate hikes. Of course, he's known to be hawkish before and showing that hawkish tone here. He also said that it doesn't make too much difference if we do the 100 basis points or the 75 basis point at the July meeting, and can adjust the rest of the year accordingly. Says our commitment to getting 2% inflation is unconditional. And so there you guys have it. Good kind of comments there that, I mean, Bullard kind of more expected. What was kind of more unexpected was Fed Daly coming out and saying that he says that we're starting to see signs of inflation coming down. Says the University of Michigan data on consumer inflation expectations was a good thing. Daly said that I don't have recession high on the list of possible outcomes, and says that the job market is very strong. And so at least from here, trying to calm those recession worries. He also said we could get a soft landing. And with that, we saw the market really start pushing on up. This came right around that kind of 10 a.m. time, and it started taking another leg here. I'll go ahead and I'll show you guys that. Let me just try to pull this down, the price action too, so that you can actually see some of this charting. All right, here you guys see the SPY. It is trying to push on up. We'll see what happens as the Fed talk really getting us up from around the 10 a.m. and then pushing us on up. We'll see if we can get to this at 386 today. But let's go ahead. Let's dive out of the Fed talk. Let's get into our economic data on the day. And so we're going to go ahead and bring up first, it's the retail sales. And coming up next at 1:15, we will be going and getting into our interview here with Dana Telsey, the CEO and Chief Research Officer at Telsey Advisory Group, asking her all about retail. So stick around for that. That should be in about 8 minutes. We'll dive into that around 1:15 Eastern time. Let's go ahead. Let's get into here of what we got in the retail sales. The month over month, the expectation here was 0.8. We got a 1.0 reading. This is, not the craziest change from the expectation, but if you look at the prior month, we were actually negative 0.3. So big change from then. And also, what other kind of economic data did we get? We got the Michigan consumer sentiment. Of course, this measures how kind of, bearish the sentiment is out there. Of course, a reading below 50 is as low as it pretty much gets. The expectation was 49.9. We actually got here 51.1, and we were at 50. So we actually bounced up there in the consumer sentiment, showing at least a little bit of sign of that inflation coming down. And that's what was stated by Fed Daily. And so, it wasn't the craziest change there, at least in my eyes, but we definitely started pushing as soon as we got that retail number in the pre-market. We came down for a second, and then boom, we started coming back up. And what does it show also is what can happen later. What is the Fed going to do here? Are we going to go ahead and get some bigger interest rate hike rates as they see retail strong and see the jobs economy strong? And so that could actually get them to be more in the tune of going for bigger hike rates. So I would keep this on watch. We'll see what happens. But like always, guys, if you guys are enjoying today's show, please do me the favor, smash this thumbs on up. Let's dive in. Let's get into what was hot and what was not. And what type of day was it today? Well, it definitely was kind of more of a risk off type of day into the opening bell. We saw a lot of action out there. Financial services still leading us now. And it looks like, there you go, consumer defensives just pushed back into the green there. So every sector from the open is actually green, showing us a really good sign here, a really good day where a lot is coming into play. Risk off, you're seeing a lot of stocks kind of push. These are the days that I talk about in live trading where you need to understand these types of days to be, more on the gas pedal into the trend, make a good amount of money. Then a lot of times when we're on the brake pedal and we're getting that choppy action. Today we got some good action right out the gates and gave us potential to make some good money there. All right, let's continue. Let's take a look at what was actually moving us. Let's go into it. So it was financial services right here. You can see here how we reacted right out the gates. We started pushing on up. We got that nice lift and it continued on up and now is looking to get to new highs, the sector, at least index that I have here. What is really leading us? Well, the banks, of course, bank globally here. You can take a look here. What are doing well? Well, a lot of it came on the heels of Citigroup report here, really getting that lift. And look how this reacted. It pulled back for just a second here out the gates and then really took off. Bank of America right behind there, 6% up. Wells Fargo about 5.9 here. We'll see if Wells Fargo can continue up. We'll talk about Wells Fargo's earnings coming on up also. And you guys continue watching. I mean, JPM up today, NTB, EWBC. You can see a lot of these up. Barclays up. This is the overall industry of banks and global. And look how this is hanging at the higher region of the price target, showing us that definitely banks are leading up right now. We'll continue to watch how this reacts and how some of these kind of continue making moves. So I'd continue to watch. Another thing that also moved up, of course, credit services. It wasn't only kind of the financial services in the banks. It was also names that you haven't seen move like SoFi, PayPal getting a nice lift there today. So keep these on your radar. We'll see what happens in financial services. Also, healthcare having a really strong day also. If you take a look here, you can see how it's continued to push. What is doing well here? A lot of it was led by a really good, strong report off of good earnings and raised guidance from none other than United Health Group. That's why you can see here healthcare plans really taking off. But also what happened here? Biotech's continuing to lead here, continuing to get that drive, right? I was seeing a stock like Moderna, mRNA, to see this kind of pausing, and I was seeing it as a good opportunity to maybe get this on a dip, and it bounced back good today. Another stock that I was watching is Pfizer. Look how this is getting off the ground today. I think this is going to make another run towards 54. This looks interesting to me. I'm going to keep it on my radar. Like always, you guys determine your own investment decisions. We'll see what happens with this Pfizer, if it can get back on up there, but definitely a strong day there in healthcare names. Biotech's having a really good day. Looks like we have some good people in the chat like always. Thank you for joining the Ghost, joining and becoming a member of our YouTube. I see Born out there, Happy, Miss Whitehorse. It's good to see you guys in the chat. Let's keep going. Jeffrey, I see you. All right, let's go ahead. Let's continue into what else. So what else was we talked about what was hot. Let's talk about what was not here. Let's talk about the consumer defensives. Was into the red. Now it's just slightly ticked into the green there. So we can talk a little bit about that. But what really was going there was like crying. Let's go into it here. Let's see the defensives. So if you look here, the defensives were getting drilled down by a couple of names. I mean, this was a little bit of a mix bag here, so you're starting to see it kind of lift off of that. I was seeing PG was into the red, and it wasn't much, right? You saw KHC, Heinz Kraft, kind of getting dragged down on this, and so we'll see what happens in these. I also saw STZ, Constellation Brands, pulling on back here. We'll see if defensives can stay into the green. They're just slightly in the green right now from the open, of course, the percentage. So we'll see if these can hold on. All right, another area that was tumbling, it did recover some. Let me see how down it is now. You can see here solar is the only industry down in technology today. Why is that happening? Well, a lot of this happening because of what happened with Senator Joe Manchin saying that he's not supporting the increased spending to address climate change, according to NBC News, and citing a Democrat briefed on the conversations. So that's why you're seeing these stocks taking a hard hit. They're bouncing back from the open. That's for sure. You can tell here by the sector, by the industry chart. You can see how it's coming back. It might make back all those losses that it had in kind of the pre-market right into the open. We'll see what happened. There was stocks like ENPH that just washed out. Look how they're recovering. Definitely recovering there in solar. But why they got hit was on this Senator News. All right. In a second, we're going to get into it with retail. I'm excited to get into it because, of course, with the recent kind of report, I want to hear what our guest has to say today. Notable gainers today on what was hot and what was not. I would have to say DraftKings, interesting move there. If you could take a look here, this is, of course, consumer cyclical, and you're looking at gambling. You could also look at resorts and casinos for Penn. But I was watching this move right out the gates. This one was a strong one up, almost 10% move, actually higher than 10% on the day. Take a look at Penn also taking off there. We'll see if these moves can continue making lifts, but not a bad notable gainer there in DraftKings and Penn National Gaming. We'll see what happens with these stocks. All right, getting out of what was hot and what was not, we're going to go ahead and play a trailer and then get to our first guest today. So like always, guys, smash the like. When I return, we're going to go ahead and be joined by Dana Telsey, CEO and Chief Research Officer at Telsey Advisory Group. So smash the like and let's go ahead. Let's dive on in.
Introducing portfolio synchronization with your brokerage. Now you can securely connect your brokerage account to Benzinga Pro, opening a world of personalization. Screen lightning fast news just for the stocks you own. Set alerts for news catalysts that affect only the companies you care about. It's all possible with a simple click and a secure protected connection. Overcome uncertainty and connect your portfolio to Benzinga Pro today.
All right, let's go ahead. Let's bring on Dana Telsey here, CEO and Chief Research Officer at Telsey Advisory Group. Welcome to the show.
Thank you very much for having me.
Excited to have you on. I know that I'll call you my retail expert because I feel like I need to go to you more often. I've seen so much work that you've done in the past, so excited to have you on here. Let's dive into first, what did you see in this retail sales report that changed?
I think overall, frankly, it definitely was a little bit better than expected. It's good to see, even with the inflationary headwinds, we saw a bit of improvement. But I think there could be a little bit of a lag, given the fact that some of these price increases have taken hold more recently. And we've also seen the level of inventory rise even more recently. So I can't wait to see what July and August numbers show, because I think we're heading into a very promotional back to school season with a lot of excess inventory that will have to be moved.
Excellent. That was actually down the list, but let's go ahead. Let's go straight to it. Of course, we saw the issues earlier in the kind of Q1 period with Target and Walmart. How do you feel the back to school season will be for department stores this time around?
I think it'll be more promotional this time around, and I think it's not just going to be the department stores. When you have companies like Old Navy looking to move merchandise like they are, American Eagle also, that's an offset to everyone. We also know, well, the back to school season, we've seen figures out there expected to be up around 7.5%. That doesn't include inflation. So the real number certainly may not be as robust. Also, we're going into second quarter earnings season in a few weeks, and I think you're going to see many of the retail companies reset their annual earnings guidance a little bit lower, given the fact that sales have slowed and it's become more promotional. It's a changed environment.
Yeah, definitely. We've been seeing more of those just kind of giving the earnings early, right? Kind of giving a little heads up about what's coming. What else could we expect to see in retail earnings coming up? Is there any kind of big report that's on your radar? The first one?
Well, all of them are on my radar because basically that's what I do. And there's always a connect the dots scenario between all of them. What I'm looking for is I want to see most recently how sales are trending. You want to see where it's happening. We're definitely seeing a pickup in store traffic, moderation in terms of online sales. We're seeing the continued shift to services from goods. But yet, with 2.6 million weddings happening this year and more occasions and events, people have been buying, whether it's fashion footwear or whether it's dresses, they are buying goods for occasions. But those occasions come September, some come October. Are we going to see a moderation there also? Consumer savings rates are back to more normalized levels. You do have the continued wage growth that's happening, but the wage growth isn't offset by the heavy headwinds of inflation. I think what's different, because companies aren't stocks and stocks aren't companies, valuations of many of these names have gotten certainly compelling given the shock to the system that's occurred. But when the reset guidance is here, I think that's what everyone's going to be looking towards. And I think in the near term, there's a lot more homework that's being done on the group.
Now, when we talk, we could get back and forth if we're going to go in a recession or not, but what industries are more resistant if we were to get into a recession here?
Well, certainly the essentials and off price. Remember, off price consumers go to because of the pricing, the value, the convenience, and the brands that they offer. So that's essentially where I'd be looking is on the discretionary side. It's off price that should be able to have a benefit in a more conservative environment.
Now, one of the stocks that I've been watching recently, of course, is Nike. We saw their earnings. It really wasn't a bad earnings report to me. You can tell me what you saw there, Dana. But it's been down about 40% from its highs. Is this an opportunity here?
I mean, one of the things with Nike, with the market share they have, the global reach that they have, the continued interest in sporting goods, that is an opportunity for companies like Nike. Big global brands have pricing power and presence. And certainly with the product innovation that Nike has, there's more to come there. I also believe that when you think of activewear and sportswear in general, I think you're seeing with the new hybrid work environment, people are dressing more casually to the office. And that's a benefit when they do go into the office to certain of the more casual apparel companies of what's acceptable today compared to what it was pre-pandemic.
Excellent. I have to say I agree with that. And it's more, sometimes you can get away with some shorts sometimes. And that's the at-home kind of life, right? It's a little bit different. We'll continue to watch how Nike progresses here. Thank you for coming on, Dana Telsey. We'll definitely have you back on, especially the next retail report. So expect to hear from us.
Thank you. Thank you for having me.
Thank you. All right, let's continue going here. Like always, we get to the experts, and I definitely wanted to touch on some retail. So shout out first to Zoten, and shout out to definitely Dana Telsey joining me, CEO and Chief Research Officer at Telsey Advisory Group. Next up, let's get into the next headline here. We want to get into some of our earnings plays that hit. Let's talk a little bit about this because this was really, I mean, what got us started today was none other than Citigroup's kind of earnings. So let's get into Citigroup's earnings here. Just one second. Let me switch this to a ticker down below. Boom. There we go. We'll get into these earnings. Let's dive on in and take a look at Citigroup. Look at this one, guys. This one held a pullback here. You can see here it was first resistance here. It tried to hold it right out the gates here. And that's what I was looking for. It pulled back there just slightly below that 46.30, recovering there. And It was buy after that on Citigroup. You can see it up there towards 49.67. We'll see if it can get to 50 today. EPS coming in here at $2.19, beating the $1.69 estimate. As soon as that hit the tape, you could see the algos really jump on this as they started raising it up. Sales at $19.6 billion, beating the $18.12 billion estimate, and really leading the way, right? It led the way also for Wells Fargo. Let's take a look at Wells Fargo. Well, Fargo actually was looking kind of like it was coming down in the pre-market until what? All of a sudden, boom, Citi started hitting. And at the gates there, boom, you got Wells Fargo really taking off here and then pulling back now. But it really just came right out the gates here. Their EPS coming actually in a miss of 74 cents there, missing the estimate of 86 cents. Sales were at 17.3 billion, missing the 17.6 billion estimate. And you can see that didn't hold it back, all due to a lot of what you saw in Citigroup and raising up the sector there, really giving it some boost and giving it that lift right out the gates. While Wells Fargo was ripping up, you were getting that pullback move in Citi, giving you that opportunity to maybe go for the leader, Citi, and the laggard like Wells Fargo catching up to the big move. But also we got BlackRock here, right? And I like this setup early on the day. I was watching it kind of set on up right around here, around the 590s. And it was looking to me like it wanted to curl back towards the 600. It did a nice move here. Let's talk about the earnings that they got. EPS actually missed here at $7.36, missing the $7.90 estimate. Sales were at $4.53 billion, missing the $4.65 billion estimate here. But that didn't hold it back. As you can tell, right out the gates, it ripped just like when you were seeing that Citigroup pull back. BlackRock was making that lift. And so you can see here, really nice move, and it continued the gains there. Last one on the banks that we're going to touch at least for today is PNC. This is a smaller one, but hey, I know a lot of friends that have it also. So PNC Financials, you can see here, look at this curve. It was going down in pre-market. That got changed all right out the gates. You could see it popped on up to 149, pulled back a little bit there, and then really started getting the strength through the 150s. Now up there towards the 152, held up all the way to 154, and their earnings came in here. They actually beat on the EPS at $3.42, beating the $3.14 estimate. Sales were missing, though, at $5.12 $5.12 billion, missing the $5.13 billion estimate. So it wasn't a miss too off on the sales. They got the good reaction. That popped on up, and you can see here, look at that candle. It's trying to go green. We'll see if it can go green on the day. Of course, we talked about healthcare and why healthcare plans were up today. And you guys can see a lot of this was based on UNH. Look at this daily move, really pushing well here. Let's take a look into it. UNH continuing to push here. We'll see if it can get through that 530 as we speak about it here. What was this coming on? Let's talk a little bit about it here. All right, sorry about that. Didn't set it up right. Let's get this going again here. There it is. All right, so United Health Group got in here a beat of $5.57, beating the $5.20 estimate. Revenue was at $80.3 billion, beating the $79.68 billion. They also lifted earnings outlook, and so I think this definitely helped. When you can raise your guidance, they expected full year 22 adjusted EPS of $21.40 to a high of $21.90. And then this is up from the prior outlook, which was $21.20 with the high of $21.70. So a little bit of raise there, about 20 cents there on the adjusted guidance. So there you guys see it. UNH really getting some lift off of that. What do you think about Tesla's new blockchain? Doesn't sound too bad, Matthew. I'll take a look into it. I'm actually going to talk about Tesla coming on up. I did see some news. I'll take a look into the blockchain. Maybe we'll do a little deeper dive. All right, let's continue going here. What other news can we touch today? We're getting out of our earnings. We'll continue watching earnings. Of course, next week, early on, you get Goldman Sachs. Bank of America. So stay tuned, guys. There's so much. Netflix next week. There's a lot going on out there. Let's continue on with the headlines. All right, next headline we're going to talk about is about Pinterest. Pinterest shares are actually trading higher following a Wall Street Journal report suggesting Elliott Management took a stake of 9%. Let's take a look at Pinterest, see how it's trading today. All right, you guys can take a look here on the tape. You can see it pushed up massively at 4 a.m. here, 4 p.m. It pushed up, and then it couldn't hold above the 21. That's what I was looking at towards the bell. You can see here we pushed up close to it, 2075. I'm looking to see if it can close back above 21. That would make me a little bullish. Right now, it's kind of sideways. We'll see what happens here in Pinterest. All right, let's continue going. Let's go to the Google. All right, you'll see here, of course, why we were looking at the Google. Yesterday, I got stopped out really close to that 2200 spot because I was looking for a little run into this. What would this be? Of course, the last day before the 20-for-1 split. So we'll see what happens with Google once we get that. But it's looking like it wants to come back towards the high. It pushed on up there towards 2280s. We'll see if we can get back up through the 2270 mark and end the day green in Google before the split, and that it takes effective on Monday. Of course, you can get into it all the way until 8 p.m. tonight. So just take a look at it. We'll see what happens there in Google. All right, let's continue going. Let's take a look at Starbucks. Next up, SBUK there. Starbucks actually getting a lift. Of course, this wasn't the biggest news, but they are kind of telling everybody that they're closing 16 U.S. stores, mostly in West Coast, by the end of July because of safety concerns. And so one thing that I have been noticing with Starbucks is that I've been hearing more and more mentions of unions coming out of Starbucks, right? We saw New York. We saw Seattle have that union. And I think this is another move that you might see more and more in the service industry, especially as you kind of see also like unions come out of Chipotle. I mean, this is something you got to keep your eyes on because it could affect these companies and start kind of like a wage battle. So I'm going to keep on watch. I'm not saying that this is what I'm seeing right now, but something to keep on watch. We'll see what happens in the Starbucks environment and also other restaurants. All right, let's get out of Starbucks. We can take a look at the daily before we do that. You can see it's coming back out. If a close up above 81 would get me out of this bearish trend. So we'll see what happens if we can get up there. It definitely has come down before, but let's see what happens in the next couple of days. All right, let's go to Tesla. Tesla in the news today. Elon Musk saying in a tweet Friday that the electric car company could lower its price if inflation calms down. And we have been seeing, inflation showing signs that it is topping. Of course, it's coming from more of the price that we're seeing in oil and not necessarily long term. Do we expect that? But for right now, it's interesting, right? I mean, Tesla is at the break of point where if it could close up past 760, I think you could start breaking through and get into the 800. But of course, if it takes out 700 again on the downside, we could easily just flush through kind of these lows here where you got, let's go ahead, let's take a look there. That's 675.10. If that cuts through and gets to the downside towards 621, you could take that out also. We'll see what happens there in Tesla. All right, looks like someone wants to talk about Netflix. I see you. You want to take a look at Netflix? I'll take a look. All right, let's take a look at Netflix. Look at that little lift off the bottom. I like the bottoming action on this chart. Really just need to get back through maybe 200. I said that I've been looking for kind of Netflix to get to the next levels on the monthlies. Let's take a look if it ever got there. All right, so in my eyes, when we broke through this kind of 300, 250 area, I was looking for the next level down here. That's towards the 196. We were using that as resistance. And the level down from there is closer towards this 150 area. So I've been looking for a move to 150 for the Netflix, but it's definitely holding right around the 170s, trying to come back through that 200. If it can get through that 200, it'll be really looking interesting for it to come back up for that gap, that it gapped down. But of course, earnings on Tuesday, so you never know. They already kind of warned, right? So I don't know what's going to happen there in Netflix. They warned about losing subscribers, but who knows? Maybe they give us a surprise. All right, let's go to Amazon now, AMZN. Let's take a look at this. The reason I'm bringing this up is because it is having a good day. Rejected to go back towards that 105 again, so it doesn't want to get below 100, and now trying to come back towards that 120. Don't forget the split adjusted. It was right around the 125, 126 price. So if it can get back through there, you're definitely going to see some bulls trying to take lead there in Amazon. What did they announce? They announced that it would soon start making drone deliveries in College Point, Texas. So, of course, Amazon's looking to continue growing their Prime Air drone delivery program. If you guys have never seen that, I'm actually show you a picture of one of these drones, what they look like. So take a look at this. But the air drones can actually fly up to 50 miles per hour and up to an altitude of 400 feet, Amazon said. So look out your window, because very soon you could see Amazon continuing to grow this Prime Air drone delivery program and delivering to your house. How do you guys feel about that in the chat? I'd love to hear what you have to think. All right, let's go ahead. Let's see what else is out there. What is moving right now? Let's take a look at the SPY. How are we doing? We're getting up there towards the 384.70s. Looks like we are just rallying. It's a rally on type of day. Apple getting off the floor now, really good, getting a nice little push. We'll see if that can end in the green. Amazon up 3.9%, really strong day there. UNH up about 5.8 and continuing to take that push through 530. We'll continue to watch how these stocks perform. Meta really getting off the ground there. ARKK, what's going on? Looks like you got back on up there. So definitely keep your eyes on that. Roblox taking a real strong V-turn upwards. Look at that, guys. Look at Unity. Look at Snow. All taking that nice little leap on up. Are the cruise lines going up? Yes, we still got some of that. It looks like a pretty much everything day kind of rally there. Even energy was getting a little bit of a lift today. Let's take a look at XOM. It's hanging out right now. We'll see if this can continue making leaps, but definitely a strong risk off type of day. All right, so we'll see what happens there. Expiration day, such movement, nice. Yeah, definitely. You can see a lot of action with options expirations coming into play today. We'll take a look at that. Up next, we're going to get into our interview that was actually a replay. I'm going to give you guys a replay of yesterday because one of our guests called out today, and it was a little bit late, so I wasn't able to replace him. But this is a really good interview that we had yesterday. It was from Thomas Hayes, chairman and managing member at Great Hill Capital, and he covered a lot in this, guys. There's not too many times that I would say that you should re-listen to my interviews. You know, I want you guys to definitely check them on out. But this one really had a lot of substance, so much that I took a look at it again. So I'm going to bring it back to you guys. You guys check this out. This is a replay from Thomas Hayes yesterday. So it has a lot of good stuff still in it. Take a look at it. All right, let's bring on Thomas Hayes here, chairman and managing member of Great Hill Capital Management. Welcome back, Thomas.
Hey, Mitch. Great to be with you again.
Definitely. Now, of course, we've had some recent economic data. So CPI and PPI hitting the tape since you have been on. So what caught your attention in these reports?
Well, the bad news, Mitch, is it was a complete train wreck. The good news is that it's backward looking. So, the numbers really couldn't have been any worse. They were much higher than expected, both on the CPI, core CPI, PPI, core PPI. And what everyone was hoping for is these numbers would come in a little bit lower than expected, confirm that inflation peaked in April and the Fed could pivot in the next month or so. That's just not happened. You had a strong jobs report. You had higher than expected inflation number in the rearview mirror. So that's the negative. The positive is if you've looked in the month of June, if you've been paying attention, which I know you have, but for your audience, all the commodities have completely collapsed. And now that even includes energy and oil. down, I think today trading 94, 95, 93 to 95 range on WTI crude, down from whatever it peaked at, 130. You've got coppers rolled over materially, corn, soybeans, cotton, platinum, cocoa, they've all collapsed. So the question is, how long does that take to trickle into consumer prices? And then we're going to start to see these numbers roll over. So it's kind of like we're getting it all at once. Opinion follows trend. And today feels like the culmination. I mean, people couldn't be more negative. Rightfully so. You know, this too shall pass. It's not fun to see these numbers come in terribly when you know, you see commodities rolling over, but it just doesn't filter through to the consumer that quickly. We're going to see that in coming months, and I think that this level of despondency is going to flip to euphoria.
Now I have to ask the question, in your opinion, do we get the 100 basis point hike rate?
Yeah, I don't think so. I think Waller basically more or less took that off the table today. I think a lot of people were starting to think in that direction after the PPI confirmed the CPI. You know, PPI is supposed to be a leading indicator, and we saw that trend in recent months, but it was worse than expected. But Waller said that he didn't need to see a lot more worse data, and the market looking at 100 basis points, maybe getting ahead of themselves. He also said that 75 basis points gets us to neutral in July. So that's a pretty big statement. And I always like to watch what people do versus what they say. I've learned that the older I get, that's a better indicator. And if you look at the Fed, you know, one thing that very few people are paying attention to, Mitch, is the fact that quantitative tightening last month was supposed to reduce $47.5 billion of liquidity from the market. They were supposed to do that much in quantitative tightening. They actually only did $7.5 billion, and they were net buyers of treasuries. They actually net bought $3 billion of treasuries. So all of the tightening came in mortgage-backed securities. And that tells me that the Fed sees these trends. They see what's happening with the beige book yesterday. You saw economic growth slowing in certain regions. So they're trying to thread a needle here. They know, they've seen what's happened to commodities. They've been successful with reducing demand. They can't print more oil, so their only play in their book was destroy demand. They've been successful in doing that. We saw that just recently in the last, depending on the commodity, 4 to 8 to 12 weeks with the collapse in demand there. So I think what they're trying to do is stay accommodative by not doing too much quantitative tightening, but present this image of being very tough on inflation until inflation falls over by itself. And the way that they'll do that is continue to jawbone, but probably only do 75 bips this month. And then if those commodity prices start to trickle into CPI next month, then they'll have an excuse to maybe go 50 in September. But if they don't, then they'll have to go 75 again. And they're going to remain data dependent. I do like the fact that they're not doing emotional knee-jerk reactions to the data, that they're trying to be measured, but they're trying, you know, it's a juggling act. You know, they could be forceful and put us into a depression, but they're trying to crush demand and try to have the landing be as soft as possible. And they're balancing between less quantitative tightening, but keeping the hikes going and hoping that these numbers can catch up. And I think when they do catch up, Mitch, they're going to catch up all at once. Just like it seems like today, every single number under the sun is horrible. I think we're going to get to the other side of that. It's the question: is it next month or is it 2 months from now? So how much longer do we have to go through this malaise and just basically burning time, waiting for things to bottom out and for the numbers to get better?
Well, it sounds like the sun is on the horizon there, but we got to continue to watch what goes on. I like how you stated there about the asset sell-off, because I think that's so important. Everyone talks about interest rates, but we have to be paying attention how that really is happening there. So I'll call it a little bit of quantitative tightening with a little bit of a Band-Aid on it, because it doesn't seem like they're going full steam ahead, at least on the asset sell-off.
Correct.
All right, let's dive into the next area. Is everyone wants to know, where are there opportunities in this market? Where do you see some opportunities, Thomas?
Well, one positive data point that came out this morning, which you touched on, was the Taiwan Semiconductor. So you saw the banks, basically miss on the top line, bottom line. JP Morgan cut off the share repurchases, not at their own behest, actually, because of what Jamie Dimon says was capricious rules, banking regulatory rules that they have to have XYZ capital, and the rules are fickle. So he wasn't happy about it. It was reported as if he made the decision to do that. They were forced into that decision. But that's a very interesting business because it's all the investment banking that really hurt them materially. And just as quickly as that turns off and credit markets are currently closed, that can turn on in a heartbeat. It's just, what we've been getting is bad news after bad news after bad news. No one is set up or positioned right now for unexpected positive news. You could get a geopolitical headline tomorrow. You could get inflation next month. You could get earnings like Taiwan Semiconductor. And the reason Taiwan Semiconductor is so important is because they're the largest producer of chips for the automotive sector. And the automotive sector is a material impact in CPI numbers. So, used car prices and new car prices have been very high because there's no supply. The reason there was no supply is because there were no chips. What Taiwan Semiconductor is saying with their earnings is we're producing chips like crazy again. We're actually seeing build in customers' inventories, like all the phone companies that double ordered chips when there was a shortage, all the electronics companies, appliance companies. But now, because of that, because those customers have excess inventory, they're focused on banging out those auto chips. And as they get those auto chips out, you're going to see a glut of new cars come on the market, which is going to be really, really positive because it's going to collapse used car prices. And it's also going to bring down new car prices. And that's a big deal. You couple that with all the inventories and the big box retailers that you're going to start to see big discounts going into back to school because they had the wrong inventory, over-ordered from COVID, et cetera, et cetera. Big discounts there. All of those factors are disinflationary. So just as we're seeing like it can't get any worse with inflation, we're going to see drops in certain areas that are going to come all at once. We just don't know if it's 2 months from now, if it's 3 months from now, if it's 1 month from now, or if it's 4 months from now. But they are coming. Those disinflationary factors are coming. But what do we want to focus on in a slower or slowing growth environment? And the end, because that the Fed had to do that to bring down demand, which we're seeing the results of that. The one area idiosyncratically that we like, that we've talked to you about in past appearances, is biotech. And the reason that we love biotech is twofold. Number one, on every metric, it's trading at multi-decade lows, whether it's price to operating cash flow, price to book, price to cash, et cetera, et cetera. But more than that, our two catalysts are coming to bear now. So the sector, if you look at the XBI, for instance, is now up some 32% since we last talked, since the May lows. And I think there's a lot more juice in that tank, and gas in that tank. And that is catalyst number one was, well, if these companies are so cheap, why aren't big pharma buying them? Well, that started to happen in the last 6 weeks. You've seen more than a half dozen multi-billion-dollar deals of big pharma taking out undervalued biotech, with the largest one being just about a week and a half ago with Seagen, the $40 billion takeout. It started with Pfizer taking out Biohaven for $11 billion. So now animal spirits are on. Big pharma has patent cliffs. They've got a ton of cash. They have to buy that innovation to grow, and they want to buy it now. One, because they're cheap, but two is because their competitors have started moving, and they know if they don't take advantage of it, their competitors are going to do that. So that's number one. Number two, the FDA has been focused for the last 2 years exclusively on COVID, getting antivirals, getting vaccines approved, and safety and all that. So they haven't been focused on approving drugs in phase 1 and phase 2 and phase 3 trials. There are quite a number of drugs now that are up for major milestones, phase 2, phase 3 milestones. We're going to start to see those come out now that the FDA is back to its normalized schedule of looking after regular drugs and approving or disproving them. And as we start to see the deal flow going, coupled with new drugs getting approved, you're going to see huge animal spirits. And the final thing about biotech is everyone says, well, how could you buy biotech in a rising rate environment? Well, The last time we had a rising rate environment was 2016 to 2018. The Fed raised the Fed funds rate from 25 basis points to 250. Biotech went up 140% over that period of rising rates. The group crashed in anticipation of the rising rates, down over 50% in 2015 to early 2016, just like the sector crashed in the last year from early 2021 until recently over 60%, and now up 30 some odd percent off the lows. We think it's just the beginning, and we do think this could be another 100 to 140% move like we saw over a 2 to 3 year period, the last Fed tightening cycle. So we think all the components are coming together, and we like that because we don't have to be waking up every morning wondering what the S&P futures are doing, because the correlation you've seen on a lot of weekdays, red days for the S&P, biotech has actually been up on quite a few of those in the last month. To a lesser extent, same with China Tech. China Tech is down in the last week because they had shutdowns again. You're going to see more and more of that, but the direction is up. China bottomed in March. Biotech bottomed in May, and both have been on an uptrend. While the general market has been weak, they've been moving up, and we like both of those groups. There's an exceptional amount of stimulus now focused in China. And as they get through these short-term shutdowns, you're going to see money continue to flow back in that direction.
Excellent opportunities to keep your eyes on. Now, of course, we have a big situation right now with natural gas in Germany and Russia. How do you see this situation playing out?
Yeah, I mean, look, the Europeans have boxed themselves in this situation.
Yeah.
So Putin can do basically whatever he wants. I mean, he's got unlimited amounts of funds coming in from China and India, are happy to take his oil barrels off his hands at discounted price. He's happy to supply them. So you're not going to drown him out financially. So now you're seeing Brussels saying, hey, Germany, like, you put yourself in this situation. Why should the whole continent suffer? Like, get over it and start to accept that supply again. And you saw today, all of a sudden, the servicing of the Nord Stream was fixed. Russia said, oh yeah, we're done with the servicing, and the energy started to flow again. So I think they're going to just have to take it the same way China and India is taking it, or they're going to be losing power. I mean, you're seeing it with in the UK. People, the number one way to get booted out of office is have high energy and high food prices, and you see it in consumer sentiment in the US. By the way, what's really interesting about consumer sentiment in the US is now at 50. Since 1980, it's gotten below 58 3 times. In all 3 instances, it marked the lows in sentiment and the highs in inflation. They were all peaks in inflation. There's an inverse correlation. When inflation is at its highest, sentiment is at its lowest. It's now at its lowest in over 40 years, which means inflation's at its highest in over 40 years. But here's what happened to the S&P in all of those instances. 12 months later, on average, the S&P was up almost 21%. So I know things look a little dim right now, but whether it's days or weeks or a couple more months, we got to wade through the malaise. There are things to do, like we discussed, before the general market kind of steadies and starts to move back up. But there are certainly opportunities, and this level of pessimism is usually accompanied by great opportunity. If you just have to take a little longer view, if you're taking a 60-minute view, it's going to be tough. But if you take, a 6-month view, 9-month view, this is when money is made. When no one wants to step in and buy high quality businesses on sale, and you slowly ease in over time, I think you're going to be very happy when you look a year out.
All right, guys, we have Thomas Hayes here, chairman and managing member at Great Capitol Hill. I appreciate you continuing to go here. We've been on since 1:15. I want to tell the chat, definitely smash it on up if you guys are enjoying the information. I got one more, so I've been enjoying the overtime. Let's do, where do you think oil prices finally get some stabilization? Because we've been seeing energy continue down, but I mean, where's the stabilization come in?
Oh my goodness. So I, I've been calling, it's interesting. So we were aggressively buying energy and energy companies in 2020 when no one wanted it, when energy was on the lows, and then we were selling it early this year. into the war strength, and the strength continued. And we said, look, it's only a matter of time. The trapdoor is going to open. All the people that hated energy and energy stocks in 2020 now love them and can't buy enough. And sure enough, they opened the trapdoor in June and collapsed. Some of these names are down 30%, 40%, oil's down, et cetera, et cetera. So I think, I think you want to see a little bit more pain and really punish those people that came in late. I mean, that's just the way the market works. It's not personal, but the key is if you're chasing things when everyone wants it, you're going to get punished. And if you're buying high quality things when no one wants them, you're going to make a lot of money. So it's provided you have patience. So I think there's got to be a little bit more pain here, because if you had talked to people 3 weeks ago about energy, they would say, you saw the notes, $386. I think JP Morgan put out a note that it was going to $386 or some ridiculous thing like that. So look, I just look at the data. Number one, we're not that production now is not really offline, because Russia's pumping like crazy and selling it to China and to India. They're selling it at lower prices, but they're selling it. So that production is full tilt. Then you've got the United States. The rig count's up, now materially from the lows. It was at 240 something, and it's now at 750. And that's down from the pre-pandemic lows of 790, and it probably goes up this week. So we're just about nearing the pre-pandemic highs in terms of rig count. So we're going to have all the U.S. production come back online. We're going to have the Russian production is there. Now you've got President Biden going hat in hand to MBS, please pump more oil. So maybe he'll get a few barrels there, despite the fact that MBS has a close relationship with Russia. You may see some there. And then guess where he wants to go after he gets a deal done with MBS, is he wants to open the spigots from Iran once again. So it seems like this administration wants to get oil from everywhere else except under their own feet at home. But slowly that production's coming back on. Why? Because not all of the oil assets are owned by public companies. A lot of private equity groups bought that stuff in the hole in 2020 and even 2016 to 2020, when public companies were divesting and the ESG movement was basically cutting off their financing it and making it hard for them to get financing to drill and to expand. But the private equity companies don't have that constraint, and they can pump all day long. And at whether it's $80, $90, $110, you can be assured they're doing it, and they're pumping all that cash out of the ground. So that production is going to catch up, and I think we're going to see the Johnny-come-latelys get a little bit more punishment. And then when we look out 3 to 5 years, I think the demand is still material. I do think there has been underinvestment, and I think later in this year there's going to be some opportunity to reload on energy, but I think it's too early right now.
Boom, there, my man, Thomas Hayes. I got to say, he's one of the best out there. He goes on a lot of the networks out there, and he covers it all. I think he did a really good coverage there, not only going into kind of the oil, but we talked inflation. We talked it all in that one interview. So I hope you guys enjoyed that. And I did catch in the chat, I see you, Easy, talking about oil, talking about natural gas. I see it going on up. I've been watching that. Have a good day also. So we'll continue to watch how that does. I was liking it today. I really was. So it's looking good now. It's recovering the 200-day moving average. I'll show you guys oil really quickly. Look how that's recovering now, the 200-day. Nice kind of rounding bottom here. Could get back on up. We'll see what happens there on natural gas. If we can get the lift or not, we'll see what happens. You wish Nord Stream was a stock? So do I, Dustin. All right, guys, definitely smash the thumbs on up. I hope you guys enjoyed today's show. We had another great one. We talked about the bank earnings. We talked about the Fed talk. So if you guys missed the Fed talk, why the market moved today, check it on out, guys. Also, we got retail sales report. We talked about Pinterest, Google, stock split. We talked about Starbucks, Amazon drones. And of course, we talked to Dana Telsey, CEO and Chief Research Officer at Telsey Advisory Group, about the retail report, what you guys should watch in retail, and what changed in this report that stood out to her. So definitely give me a thumbs on up. I'll see you guys next week. And of course, we'll keep battling here on Stock Market Movers, where we cover all the headlines and get to 2 experts in 1 hour. So let me know if you guys appreciated today's show and appreciate the style of show this is. I'm trying to do my best to go ahead and make it different than our other shows. I hope you guys are enjoying it. Hit the thumbs on up on your way out and let me know in the comments, what do you guys think?
We'll be right back.